No great surprise, but we have a lot of reversals this morning. A lot of things that got stretched yesterday are going the other way this morning, including Tesla stock. Now, it's also triple witching hour today, and I'll explain what that is much later as we get closer to giving the stock results for the day. A lot of volatility expected, and that's what we're seeing so far. Okay, so this was, I love this today on X from you want my handle. You want my handle. That's the letter U. You want my handle. So if you want to find this guy and follow him, or gal, could be a gal. My daughter just had her first day of college classes. Her professor of government made it a point to acknowledge and thank Elon Musk for buying Twitter. She said it started a cultural shift that has allowed more open discussion. Wow, look at that. One professor, probably in the entire country, that believes that. But that's one. Maybe tomorrow we could have two or three. All right. Gary Black said this yesterday, so take that into consideration. Why is Tesla up 7% today? Yesterday. As we pointed out to our subscribers this morning, Fed's 50 basis point interest rate cut helps long duration equities like Tesla the most, since all the value is in the tail. In other words, people are looking for Tesla to grow rapidly for years and years and years. So the further out that you're taking your valuation plans, so let's say you're analyzing Tesla 5 years out, and you're saying, okay, in 5 years, it'll be worth 25 trillion or 10 trillion or whatever number you want to pick. And then in 4 years, it'll be worth this, and 3 years will be worth this. So when you're going way out there in order to get some really serious big numbers and you believe it, you have a high likelihood of that happening in your scheme, then you back that up based on based on the expected interest rates, not just the interest rates as they are right now this minute, but also expected interest rates. So now we have an expectation of interest rates going down over the next few years. You take that evaluation 5 years out and you say, okay, based on the interest rates between now and then, let's back that up to a present value based on each year's reduction in value, because you're going to pay less now for something that is only going to be that valuable later. Anyway, hope that helps. Anyway, so the Tesla growth narrative is about to change. This is Gary Black now. He's a bull, but he's usually kind of moderate, maybe even pessimistic. The Tesla growth narrative is about to change from negative to positive, starting with third quarter deliveries and continuing into fourth quarter and 2025 with the launch of the $25,000 to $30,000 Tesla compact car. We expect longer duration, high PE growth equities such as Tesla, and he mentions some others here, and NVIDIA among them, to do best in an accommodative Fed environment. With long duration equities, most or all the valuation is in the tail because there's a little cash flow up front. Now, in case of Tesla, there's lots of cash flow up front. When one discounts a tail holding 67% of the cash flows at a discount rate that is 50 to 100 basis points lower, and also expected, he doesn't say this, expected to go down another 150 basis points, the valuation increases can be significant. A secondary positive, consumer non-durable goods such as home, auto, and furniture financed by loans will now have lower monthly payments, so in theory, become more affordable. Now, he called that consumer non-durables. Those are durables. Got that backwards, Gary. Okay, last night, Tesla posted another strong, this is also Gary, another strong 15.6 insured registrations for the week. With 2 weeks left of the quarter, Tesla's China third quarter registrations are on track for the best quarter ever and are 20% up year over year, 26% quarter over quarter. With a $25,000 to $30,000 Tesla compact coming in 2025, investors increasingly believe autonomy can boost Tesla's FSD take rates and overall Tesla EV sales. Tesla can again generate secular earnings growth after 2 years of sharp earnings decline. And Wall Street is looking for third quarter deliveries to grow about 6% overall, and fourth quarter deliveries growth of plus 2%, and full year 2025 deliveries growth of 14%. Now, Elon is saying that next year's delivery growth will be back to 50% again. What could change the mindset back to Tesla this could all change the mindset back to Tesla being a growth stock? Well, you're going to have a massive increase in the amount of energy, megapacks sold next year. You're going to have a very large increase, probably on the order of 50% in the cars, and you're going to have a huge uptake in FSD compared to this year, as China is open, as Europe is open, et cetera, et cetera. I mean, it's just going to be a great year, but wait till 2026. Okay. Phil Roberts says this. He says, that's at Phil Roberts. So that's the end of how long do batteries last argument. CATL is now going to give a 10-year, 600,000-mile battery warranty to 85% of capacity. So now your battery will last at least 600,000 miles and will have 85% capacity at the end of 600,000 miles. That means the life expectancy has got to be at least 900,000 miles. Let's put it this way. For most of us watching the channel now, you could buy your Tesla car today. We're assuming that Tesla's batteries will last just as long as CATL's. You buy your Tesla car today, you will never, ever, ever, ever have to worry about the battery. Not a chance. All right, this is Randy Kirk. Please hit like and subscribe, hit notify. Now, notify. We've got Cern Basher coming up again today. Amazing, fun show yesterday, and another one today. Probably even better than yesterday's. Hard to choose. They were both so great. And then Warren Redlich over the weekend. We got your favorite Larry Goldberg on tonight to help me bring in Good News Friday, because by the time we get there, we will find some good news. Might even see that the stock is back up again, back into the green, because triple witching, lots of volatility, no telling how it's going to end up at the end of the day. And then, of course, another Patreon member, Brian H., joined. Thank you, Brian H., for joining up. We could use a few more. All right, David Rosenberg in the Globe and Mail. I have been receiving quite a few emails regarding my blown U.S. recession call. By the way, David Rosenberg is a goat, okay? He's like very, very an acknowledged expert in so much of this stuff. He says he's had a bunch of people saying that he blew his U.S. recession call, and it may be time for me to embrace the Goldilocks economy where the business cycle has emerged as a relic from the past. Many folks are quoting Claudia Sahm, SAHM, as saying she is not at all fussed about the fact that her own labor market rule has already flashed the recession signal. She's saying, well, yes, it flashed the recession signal, but it doesn't matter because of all the illegal immigration that's coming in across the southern border. Well, he says there are many similar emails, and he had those same calls back in 2007 when he was predicting that blow up. And by the way, I predicted that blow up as well. I can prove it. I have blog posts from 2007 saying that the derivative market was nuts, that there was absolutely unsustainable, and that we better watch out. George H.W. Bush II also said the same thing. The best thing I did then was to follow my instincts, he says, and my judgment did not waver or throw in the towel on my theory. And it feels very much the same to me today. Now, I don't think that's quite true, because he should follow his instincts is still true. We are not looking at anything like 2008. There's nothing out there. Now, the big debt overhang, yes, it's huge. It's a problem. It's not going to be anything like the 2008 story. Employment is always this is so important. The employment is always the last man standing as the cycle turns, and there's so much weakness in so many parts of the economy. Housing, commercial construction, industrial, auto now falling. Also, he doesn't mention transportation, trucking. We'll talk about that in a second. It's, a lot of sectors, okay? Does this sound like what Randy's been saying? The consumer has hung in there, but there are numerous strains beneath that veneer. The myriad of deficit-busting fiscal stimulus package packages these past 3 years provided a strong antidote to the most, he's a good writer, to the most acute U.S. Federal Reserve tightening cycle since the Paul Volcker era in the 1980s. But even here, the incremental growth boost to gross domestic product has shifted to neutral. And we'll show that in a minute. And as was the case in 2007, as the cycle was turning, all of a sudden the data underwent significant revisions, which is why the National Bureau of Economic Research waited until December 2008 before telling the world that the recession nobody was aware of until Lehman failed in September of 2008 had actually commenced a year before. Most pundits fail to realize that the initial government data release are of limited sample size and prone to huge revisions down the road. That's why I'm saying that the third quarter right now, where the Fed is saying it's going to be up 2%, other people are thinking we're up 3%. It's nonsense. Besides that, 2% is not keeping up with inflation. When you read the business context, when you read what business context we're telling the Fed district banks in the latest beige book, which I went into great detail on. If you didn't see that, you can go back and look it up. It contains the same language we saw in July 1990, March 2001, and December 2007. Half of the United States is in recession right now when we apply data science to the commentary. Not only is half of the sectors in recession, but I've been pointing out that half of the folks are in recession, those making roughly under 125,000 a year. As we saw with the quarterly census of employment and wages, and August's huge 818,000 downward revision to payrolls in the last 12 months, the government data are riddled with huge sampling errors. I will not be duped. Yes, the stock market is behaving extremely well. Much of this reflects the anticipation of the interest rate cuts and the discount effect on future cash flows that we just talked about up there with the Gary Black article. But the bond market is actually telling me that our macro call is on track, his macro call, and it is the bond market that tends to be much more prescient, especially at inflection points in the economic cycle. As for Claudia Sahm, we are friends, and with the utmost of mutual respect, the reality is that the 30% of the increase in unemployment rate from the lows has been due to layoffs, which is not at all unusual ahead of recessions. So the big layoffs come later. So I definitely have a less what me worry attitude. It's pretty funny. We were just talking about that with somebody yesterday with Mad Magazine and what me worry. Labor hoarding is intact, but that is not really a signpost of economic well-being any more than home prices rising to record highs on the back of razor-thin inventories as existing homeowners become prisoners in their own units this cycle after locking in their mortgage at generational low interest rates. We've been talking about that. The fact that hiring rates, the true measure of labor demand, are slicing lower like a hot knife through butter is a telltale sign of the cracks surfacing on the employment scene, and obviously now catching the eyes of even the most ardent hawks over at the Federal Reserve. The job of monetary policymakers is not to fall too far behind any curve and to focus less on yesteryear and more on what lies around the bend. While many, including yours truly, fell way behind the inflation curve in 2021, though the Fed is privy to information the rest of us don't have, the Fed, through its data-dependent strategy this year, allowed itself to fall behind the economic curve. It wasn't that evident in 2021 just how far the Fed let itself fall behind the inflation curve, but it sure did become apparent in 22 and 23, and the policy response came fast and furious, and with that, the incredible cyclical bear market in Treasury notes. Unbeknownst to so many out there who gazed at the flawed and backward-looking macro indicators, the Fed is now just as much behind the growth curve as it was behind the inflation curve 2 years ago. Now listen to this. This by no means suggests we're going back to the zero bound on the funds rate. Barring either a severe recession or financial accident, that's not going to happen. But going back to the pre-pandemic level of 1.7% for the Bank of Canada's policy rate is a solid bet, and curve dynamics would therefore peg the low in the 10-year T-note as 2.25 to 2.5%, which means bond investors can look to what they have already experienced since the yield peaks in 2023. All right, so you mentioned, remember I was saying 5% was the top. Right now, we're at 3.75, roughly 3.72. People are saying, oh, we're going to go back to 4. No, we're not. 3.75 is probably the high. So this is not investment advice, but bonds are going to continue to go down. Now, they're not going to go down next week. We'll talk about that in a second as well. So double-digit equity-like returns with no need to take equity risk at nosebleed multiples. Okay, so now you know how much I trust the freight information to be a leading indicator. Canary in the coal mine. Well, Fedex this morning reporting, this is on CNBC, Fedex reporting a steep quarterly profit drop and lowered its full-year revenue forecast. This is bad news. It did this on Thursday after its customers continued to trade down from speedy pricing delivery to cheaper, slower options. Shares in the Memphis-based delivery giant tumbled almost 11%. I think it's even worse than that now, dragging down also the shares of United Parcel Service, down 2.5%. The shift to less profitable packages is squeezing profits at FedEx and UPS, while the latter pinned the blame on a flood of volume from China-linked e-commerce players that Reuters identified as Temu and Shein. FedEx pointed to the drop in priority shipments between businesses. Okay, what is the Temu and Shein thing? In other words, people are buying a lot of their junk now direct from China, and that is not using UPS or FedEx to deliver. CEO Raj Subramaniam said industrial demand was softer than expected. Shipments between manufacturers and other companies in that segment are the most profitable from FedEx, which is often seen as a bellwether for the U.S. economy. The magnitude of see, I'm not the only person that thinks that trucking is a bellwether. The magnitude of the Fed rate cuts yesterday signals a weakness in our current environment, Subramanian said, referring to the Federal Reserve's decision to cut interest rates by 0.5 percentage point. This from the real EJ Antoni. Okay, he says retail sales are up 15.2% over the last 3 years, but it's almost all inflation, with the real change being a statistically insignificant 0.1% over the same period. So during the Biden years, we have had no increase in unit sales of products. All right, it's all inflation. So all the retail increases, it's completely gone. All inflation. That's why trucking has been dead for 3 years. Trucking has, well, a little over 2 years, trucking has been dead. Why? Because they're not moving any more product. It's the same amount of product. Nominal sales are up 2.1% year over year, and real sales are down 0.4% this last year. People aren't buying more. They're just paying more. Okay, today is the triple witching hour. I promised to give you some information on that. So I asked Grok because I wanted to get it exactly right. Triple witching day refers to the specific date on which 3 types of financial derivatives expire simultaneously: stock options, stock index futures, and stock index options. These days occur on the 3rd Friday of the contract month for March, June, September, and December. And here's why it's significant. Number 1, increased volatility. Because the large volume of expiring contracts, there can be increased volatility in the market as traders and investors adjust their positions. People are getting out of them at the last minute. They're making decisions about trading out of one and into another. Lots and lots of activity. And that activity is going to be especially pronounced after a giant run-up yesterday and the Fed decision on Wednesday. High trading volumes. There's often a surge in trading volumes as options and futures contracts are either exercised, closed out, or rolled over. I guess I just said that. Liquidity movements. Significant movements in liquidity can occur, impacting the prices of stocks, especially those that are heavily optioned. Who's heavily optioned? Tesla is usually the #1 most optioned product out there, or are part of major indices, of course, Tesla. Again, the term witching hour has been used historically for the expiration of options, but triple witching specifically refers to this triple expiration event. Now, a bit of personal financial advice from me. Headlines about the Fed cut and actual lower mortgage rates are going to spur more activity in the housing market. This means we're likely to have very good resale market and maybe even new housing sale. Yeah, probably, definitely new houses will also be selling better in this winter and in the fall and winter this year, just like last year. That's my expectation because there's no inventory. And now that interest rates have come down, and most people are not going to know what I'm going to tell you next because they're going to say, oh, the Fed cut. Now I can go out and buy a house. No, that's already happened. The mortgage has already dropped from 8% to just over 6%. So mortgages like treasury bonds are already seeing increases in rates. I'll show you that in a minute when we look at the bonds. So now, right now, this minute is the perfect time to act. If you're thinking about buying a house, now's the time to do it. You want to do this before housing prices go up even more, because they're gonna. And this is the time when interest rates are going to be flat now for probably the next 3 to 6 months. And as interest rates drop further later, then those mortgage rates will start coming down again. They might come down some. Now, if they come down a lot more than I say, and I'm completely wrong about this, what you can do is you can just refinance, and all the different mortgage companies have some kind of refinance plan. Now, I've told you about Bill Rayman, my buddy. I'm not telling you about this because of him, but he is my friend of over 20 years, and he's also my client of over 17 years, and he's a top 1%er in the country in the mortgage business. His information is down below in the description. Where, by the way, he doesn't pay me to say that, okay? He pays me to get him business, so in a way, but he does not pay me to give you that ad, if you want to call it an advertisement. All right, so where are the markets now? Let's go ahead and we'll start, of course, with the Dow Jones is down. The Dow Jones is red. That means down, Randy. 48.66 points. The NASDAQ down 54.95 and the S&P down 15.25. So not a huge amount. Tesla is down 511. That's the most for the day. It's been down around 455 pretty much since the market opened. It took a few minutes, but it got down to that level a little bit. This is not a huge drop after the massive increase yesterday. So far, we're not seeing this huge volatility. We've seen a drop-off that happened pretty much from the opening, and that's where the markets are looking right now. When it comes to the Magnificent Seven, it is a mixed bag. NVIDIA, Microsoft, Amazon down. The other ones are up. When it comes to the Cathie Woods, they are all down because they were all up strongly yesterday. So they're all down a little bit, not terribly much, but a little bit. Some of their, so it's taking some of those profits across the board. Now we're going to see that in a minute with the bonds too. So we've got the Dow down 0.15%, NASDAQ down 0.45%, S&P down 0.35%, and Tesla down 1.98%. Just like yesterday, a little bit more than the normal, percentage basis over the NASDAQ. Where will it end up today? Well, even now it's kind of starting to tick up. Everything's starting to tick up a little bit right now. Expect volatility. What can I tell you? Tell you 3 or 4 times. It is going to be a volatile day. You can count on that probably. All right, let's look at the bonds. So the 10-year this morning at 3.749. Well, changed right in front of my face, 3.758. I don't think it's going to go much higher than this, but what do I know? I'm only making a prediction. 3.758, that's high. I think this is just, again, profit taking off of yesterday, or actually off of months now, as it's dropped from 5 to 3.75, okay? So where we got the 2-year is also up this morning, 3.8 basis points at 3.642, still staying inverted as it should. The 2-month is up quite a bit this morning, up 5.7 basis points after dropping huge yesterday. So that's not terribly surprising. Interestingly, the 3-month is actually down again today, 2.5 basis points. Some people say the Fed pays more attention to the 3-month than the 2-month. It's now at 4.709. That is under 100 basis points. And the 2-month is almost exactly 100 basis points at this point, down from 150 not that long ago. All right, let's go on to oil. We have got oil this morning down again, 0.27, 27 cents on Texas Intermediate, which is 0.38%, or $71.68. So staying above 70 quite handily. And Brent down about 53 cents at 74.35. Natural gas down 0.17% to 2,344. but that's still a good dollar amount for natural gas. We have got, by the way, in October, the natural gas people tend to use like the middle of October is when they start figuring out what they think the winter is going to look like. Gold up 1970 this morning. Is this an all-time high? Let's take a quick look. Whoops, I did that the wrong way. We've got gold. Let's see here. It is all-time high, 2,634. Up $20.30 this morning. We got silver down just a tad, down 0.25% at 31.34, and copper down 0.18% at 4,339. We've got the dollar up a full percent against the yen, down 0.14 against the euro. So this is, overall, you'd expect the dollar to be down when you have the Fed cutting interest rates. We have got Bitcoin, very little movement today, up 21, sitting at 63,402, so staying in below what used to be the range. The range used to be like 65 to 75, something like that. And then that's it. Yeah, that's all that we do in the mornings here, except go back and take another look at Tesla, which is still sitting in that same spot. So the volatility, it started out a little volatile, but right now, not so much volatility. Now, Cern Basher. Now, I want to tell you something about Cern. It's important for him to do better. He wants every single one of his shows to be better than the last one. And yesterday morning, if you didn't see it yet, go take a look. Here's the card right here. I think he did outshine himself. And quite frankly, the one that's going to be available later today around 11 o'clock California time, that one is also a mind-bendingly good version of this kind of stuff. If you like what Cern does, you're going to love this show. It is fabulous. So take a look at both of those. We've got Larry Goldberg coming up later tonight, as mentioned. And then I've got 2 videos coming up this weekend with, Warren Redlich. Warren's back. So I think you'll enjoy both of those. We talked about a lot of stuff. It's hard for me even to characterize the conversation because we talked about so much different stuff. All right. That's all I got for you right now. Hit that. Thank you so much for the 2 folks that have recently joined on Patreon. I do need about, 72 more. If you could be one of those, one bite at a time, one at a time. All right. That's all I got. It's been great talking to you, and bye.